Hello again, everyone. Dr. Trussell here. In Chapter 6, we're going to talk about reporting and analyzing inventory. In Chapter 5, we talked a little bit about inventory in terms of merchandising concern, but our focus there was on determining cost of goods sold. In this chapter, we're going to move on and talk more in depth about inventory itself, that is the asset inventory. So we'll be talking about three different broad categories: classifying and determining inventory, how do we figure out what type of inventory it is, and how do we determine what quantities we have, how to cost it, that is, what value do we put on it, and again, how do we analyze inventory. In terms of classifying and determining inventory, we had in the last chapter we talked about merchandising companies. Remember, that was in chapter 5. And there's only one classification of inventory, which we call merchandise inventory, because they're buying inventory from a manufacturer. And we also have what's called manufacturing companies, which actually make the products, and they have three different classifications of inventory: raw materials, work in process, and finished goods. Think about, say, building a car. The raw materials would be the glass and the steel and the rubber, all that goes into making it. The work in process is when it's on the assembly line. You have inventory that's on the assembly line, and the finished good would be the finished product that you have to sell. In terms of determining quantities, we talked about in chapter 5 the difference between a perpetual system and a periodic system. In the perpetual system, remember, that's the one that you update constantly every time you have a purchase or a sale. But we need to take what's called a physical inventory. A physical inventory is a count, actually going out into your warehouse or wherever your inventory is and counting it. And we do that to make sure we have accurate counts for the perpetual system. But remember, in the periodic system, we don't keep track of inventory on a day-to-day basis, so we have to count it to figure out how much inventory is on hand. Taking a physical inventory means counting, weighing, or measuring each kind of inventory on hand, going out into the warehouse, going out wherever your inventory is, counting it. You normally do that when the business is closed or when business is slow, and it's done at or at least near the end of the accounting period. And if you recall, in chapter 5 we talked about goods in transit. We talked about FOB destination, which means the goods are transferred when they meet the destination of the purchaser, versus FOB shipping point, when the goods are transferred once they're loaded into the shipping truck or however you're sending it. So goods in transit should be included in the inventory of the buyer or the purchaser when what? When they're FOB shipping point. In other words, they're not included in their inventory until it reaches the destination of the buyer. What about what we call consigned goods? You might have heard of consignment shops. Basically, a consignment shop is where you take your clothes or furniture to try to have some store sell it to you. And so we call those consigned goods. But what about the company that holds those goods? So that's what we're talking about here: to hold the goods of other parties and try to sell the goods for them for a fee, but you do not take ownership of the goods. And the question: many car, boat, and antique dealers sell goods on consignment. Why? Well, because it's sometimes difficult to sell your own car or a boat or antique, so you need a company to help sell them for you in a store where you can have more volume. But that antique, the dealer itself does not own the merchandise. Now we're going to talk about costing. That is, when you put the inventory on the balance sheet, how do you come up with the cost? What's the dollar amount that you use? Inventory is included at cost, And cost includes all expenditures necessary to acquire the goods and place them in condition ready for sale. Typically, that would include the purchase price, any taxes that you spent, and any shipping costs that you spent. Then the unit costs are applied to the quantities to determine the total cost of inventory and the cost of goods sold using the following costing methods. In other words, we have 4 different methods to come up with the cost. 4 different methods, and we're going to teach each one in turn. We have specific identification, we have first in first out, better known as FIFO, and last in first out, better known as LIFO, and average cost. These are different ways to come up with the cost of the inventory. Let's take each one now. So here's an illustration. Crivets TV Company purchases 3 identical 50-inch TVs on different dates at cost of $700, $750, and $800. During the year, they sold 2 sets at $1,200 each. The facts are summarized below. Okay, the question is, when you sell the goods, under here, when they're sales, when you sell those, so that's going to be your revenue, you also, remember from chapter 5, had to have cost of goods sold. So which 2 did you sell? And you know, when you buy from the manufacturer, you have different prices that you buy them for. So you have to decide which 2 did you sell. And that's why we need these different methods to determine which 2 you sold and then which one is still in inventory. With specific identification, then you identify which ones in particular you sold. For example, we can assume, not make an assumption, we know, for example, we sold the $700 one and we sold the $800 one. So that our cost of goods sold would include adding those 2 together. That would leave us in ending inventory in the balance sheet the $750 one. So specific identification is when the actual physical flow costing method in which items still in inventory are specifically costed to arrive at the total cost of the ending inventory. So you know you're able to identify specifically which ones you sold. We sold the $700 ones and the $800 ones, which means on hand are the $750. This is pretty rare because it's difficult to kind of keep track of them that way. So most companies make an assumption. We assume which ones we sold, and that's called the cost flow assumptions. Under the cost flow assumptions, again, we just assume which of those 3 TV sets we sold and which ones are on hand. It does not need to be consistent with the actual physical movement. So in other words, you might sell the oldest ones first. That doesn't mean you have to use FIFO. So here's an illustration, a little bit broader illustration. So you started the year in your beginning inventory on January 1. You had 100 units, each one costing $10. To get your total cost, you just multiply through to get your total cost of $1,000. And then you purchased 200 at 11, 300 at 12, 400 at 13. Notice that the cost that you paid from your supplier was increasing during the period. Maybe there's inflation. Okay, and you might remember from chapter 5 that beginning inventory plus purchases minus ending inventory is cost of goods sold. But how do we know which ones are in the ending inventory? So if we had 400 and we did a count and we had 450 left, and we need a dollar amount of those. See, I know which units, but I don't know the dollar amount. So are these 450? How do I know the unit cost? Are they $10 ones, $11 ones, $12 ones, or $13 ones? I don't know. So we're going to make an assumption. First in, first out, The assumption is the cost of the earliest goods purchased, the first goods in, are the first ones to be sold during the year. So therefore, we assume that the oldest ones are sold first. And this typically parallels actual physical flow. Not necessarily, but that's typically how you sell them, right? If you're selling milk, you want to sell the oldest ones first. So companies determine the cost of the ending inventory by taking the unit cost of the most recent purchase. Why? Because the oldest ones are sold first, so which ones are still here? The newest ones. So back to that same example, which ones are the 450 that are sold? Okay, so we work backwards. You start with the most recent. We know we sold 450, so we start with the most recent. They're still on hand. First in, first out. The last ones in are still on hand. So the last ones in are the $13 ones, but that only gets us to 400. We know that we sold 450, so we need 50 from the next lot up, which is the $12 lot. So we also had 50 at 12, which gives us 450 the units that we know that are on hand. But notice some of them are on our hand at 13 and some of them are on hand at 12, which leaves us with what? We know that that would leave us with all of these plus 250 of the $12 ones. So remember the formula: cost of goods available for sale minus ending inventory is cost of goods sold. So to kind of summarize that, the ending inventory is going to be what we call the last in, still here. If what we sell is the first ones, first in, first out, or first sold, then what? Lish is the last in, are still here. The second assumption is the last in, first out, or LIFO. Cost of the latest goods purchased are the first to be recognized in cost of goods sold. Although, so we're assuming that the last ones we purchased are the first ones we sold. And this is rarely the case in the physical flow. It's the same example that we used before. In this case, last in, first out. So which ones are still left? The first ones. So we're going to start with the top ones. So the ending inventory, now we need to go down until we get to 450. So we're going to have all of these still on hand, which are going to show down here at the bottom. We're going to have all of these still on hand, which we're going to show down the bottom here at 11. And we know that we're trying to get to 450. We're at 300, so I'm not going to need all of these. This next lot, I'm only going to need 250 of those. I'm sorry, 150 of those to get me to the 450. Okay, and what's left is all of these plus some of the $12 ones. Now, to get our goods available for sale, we take the cost of goods available for sale less ending inventory, and that's going to give us our cost of goods sold, 700. Last in, first out. The last in, so we're selling the last ones first, and the first ones in are still here. So we kind of work our way down from the top. Okay, so another way to think of last in, first out, that's which ones are sold. So which ones are still on hand? First in, still here, or fish. And the third method is called the average cost method, and allocates the cost of goods available for sale on a weighted average unit cost. So we're not assuming the first ones are sold, we're not assuming the last ones are sold first. We just assume that an average one is still on hand. So we're just going to come up with the average and assume that's what's in ending inventory and cost of goods sold. So same process now. So same setup that we had before. Now, so what we're going to do is we're going to get an average. Now we're not going to take a simple average. A simple average would you take the 4 unit costs and just divide by 4. We're going to take a weighted average. And the reason why we don't do the simple average because there are fewer, say, at $10 ones than there are $13 ones. So the weight needs to go more towards the $13 ones because there are more of them. So to get the weighted average, you're going to take the total cost of goods available for sale and divide it by the total units, and that's down here. And that gives us a weighted average cost of $12, and we'll apply that cost to the 450 units in ending inventory, and that gets us 5,400, and therefore our cost of goods sold is 6,600. So with the average cost, it just means whatever comes in goes out, it's all at the same average. It's $12, $12, and $12. That's $12. Now let's take a look at comparing them. Now the cost flow assumption does not affect your sales revenue. The only thing that affects, it's 2 things it affects, are the ending inventory and thus your cost of goods sold. So no effect on sales or anything else. It's only the effect is on your ending inventory here. Notice these are all different. And of course that's going to make your cost of goods sold different. But the point is, look what happens to your net income. See the bottom line here? And that is, so in other words, just because you choose a method, now these are choices, the company gets to choose which one they want to use. The accounting method will have very different results on your net income. So here's a review question. The cost flow method that often parallels the actual physical flow of merchandise is which one? Well, that is FIFO. The first ones in are typically the first ones sold. But remember, as an accounting method, you do not have to choose the method that matches your physical flow. In a period of inflation, the cost flow method that results in the lowest income taxes, well, if you go back 2 slides, you'll see which one has the lowest net income. And the one with the lowest net income is LIFO. Lowest net income means lowest taxes. Next topic is the lower of cost or market rule. This is talking about on the balance sheet, what value do you show as your inventory? Well, we just figured out what the cost is. That's what those previous slides were, determining the cost. But on the balance sheet, you can use which one is lower, the cost versus the market value. And some companies can write down the inventory to its market value if the market value drops below cost. Market value meaning the replacement cost. Well, how much it would cost to go out and buy it if they had to replace that inventory. And that's an example of conservatism. We write it down. Now you cannot write it up, but you can write it down. Here's an example. Compare your cost to your market price. Now remember, market is replacement cost, what it would cost if I had to go out and buy it today. And we choose the lower. 55,000 is lower there. The next one, 45,000 is lower. The next one, 45,000 is lower. And the last one, 14,000 is lower. And so we add up our inventory and it is $159,000. That's how we would value it on the balance sheet. Now remember, for cost, we would have used one of those 4 cost flow assumptions to come up with that number. Now let's talk about analyzing inventory. This is critical for companies that have a lot of inventory, which are merchandising companies and manufacturing companies, because if they have a really high level of inventory, it's a lot of storage cost. Think of the warehouses and things that you have to have, and things can become obsolete, particularly in technology fields. On the other side, if you have too low levels, you might lose sales because people get tired where they don't have any on hand. I'm not going to buy it. So we have a couple of ways to monitor our inventory. One is called the inventory turnover ratio, which is your cost of goods sold divided by your average inventory. That tells you how many times you sell your inventory during the year. The second one is kind of a variation of that one. You take that inventory turnover ratio in the denominator and divide it into 365. And that'll tell you how many days of inventory you have on hand. In other words, if you didn't buy another piece of inventory, how long would it take till you run out? How many days till you run out? Here's an example using Walmart. So here's their ending inventory and their cost of goods sold. Come up at the top here and just plug that into the formula. Cost of goods sold divided by average ending inventory. The average ending inventory, we take the beginning and the ending and then divide it by 2 to get the average. So this means 9.1 times. That's how many times they buy and then sell, which we say turnover, buy and sell their inventory. And then we can convert that into number of days by putting that in the denominator, divided into 365. And so what that means is that's how much inventory they have on hand, 40 days until they run out. You want that to be not too long because it costs money to hold it, but not too short because you might run out. And you can see, so typically speaking, you want the number of days to be smaller. There is a low level of that, but typically you want it to be lower. And you can see what's happening to them in 2010. It's the same as 2011. Compare that though to Target, and Target has quite a bit more on hand, where the industry average is roughly what Walmart is. Recall from chapter 5 that we had 2 inventory systems, a periodic system and perpetual system. What I've been illustrating in terms of FIFO, LIFO, and average cost is the periodic system. So here's an example of the perpetual system. It's a little more difficult because you have to keep track. You have to do your LIFO and FIFO after every purchase and sale. So it matters when you buy and when you sell. So for example, here in 9/10 when you had a sale, well, you didn't have these $13 ones down here because that happened later. So our calculation is a little more challenging. At the beginning inventory, you had 100 at $10. Then you bought 200 at 11. So what do you have on hand now? You have the beginning inventory plus those 200 you just bought. And then you purchase 300 at 12. So now these are just different layers. All right, you have those what you had from the previous 2 purchases plus the new purchase. But what happened on September 10th when you sold? Okay, what did you sell? You sold, you had 100 at 10, 200 at 11, and 250 at 12 to get you the 6,200 cost of goods sold. What's on hand? Only 50 of the $12 ones. Then you go into November and you buy the 400 at 13. So you still have these 50 at 12. You still have those, plus you have the 400 at 13, which gives you 5,800. Now notice that's a little bit different than the periodic system we were using before, and that's because of the timing. Last in, first out, it's the same kind of problem. When you buy, you kind of keep track of the different layers of inventory. So the first part here is very much like the previous one. However, when you go to sell, which ones do you sell first? LIFO, you sell the most recent ones, and then you work your way back up this way. So we sold 300 at 12 plus 211 plus 50. That's going to give you your 550 that you sold for 6,300 cost of goods sold. Now what's left? What's left is 50 of these $10 ones. So once you now buy the $13 ones, you'll have those same 50 plus those $13 ones, and notice the difference in your ending inventory. Now your average cost is a little bit trickier. You have to redo the average every time. So we had the 100 at $10. April 15th we bought 211, and then we bought 300 at 12. And so what's on hand? Okay, what's on hand is the average cost. Now you're going to get the average between the first and the second one to get that amount available. And then your cost of goods sold is going to be at that same average. And notice it's different, 62.33. And then we had 50 at the same average, $11.33. So notice the average moves. It's the same computation that we did. Cost of goods available for sale. We just used a different average cost. And that leaves us with 450 at $12 and just a little bit more than $12.82. We also have an issue with inventory errors. Companies tend to make errors when they count their inventory. So for example, they may forget to count something or price it incorrectly, or they didn't properly recognize the transfer of legal title to goods in transit. In other words, they sold something but they still counted it. Or maybe they failed to count something. And then the errors affect both the income statement through cost of goods sold and the balance sheet through inventory. So think about the cost of goods sold formula: beginning inventory plus cost of goods purchased minus ending inventory is cost of goods sold. So notice that if there's an error and say you counted something wrong here, it's going to affect the ending inventory and the cost of goods sold through this formula. And just to give you some examples, if the beginning inventory is understated, that's going to understate your cost of goods sold and overstate your net income. So understating ending inventory will overstate cost of goods sold from that previous slide. And the balance sheet effects, again, your ending inventory, if that's miscounted, you're going to have an error. But here's the issue: if it is miscounted last period, it's going to affect your beginning inventory too as well. Let's look at some IFRS issues. Basically what we're saying here is GAAP allows LIFO, US GAAP, but IFRS does not allow it. So no LIFO allowed under IFRS. And also IFRS defines lower of cost or market. IFRS defines market as net realizable value. And remember that GAAP defines market as replacement cost. So it's a different definition of market value. Here's another issue. Under lower of cost or market, we might be writing down our inventory. But under GAAP, you cannot write up a previous write down, but under IFRS you can. So which method of inventory costing is prohibited under IFRS? We know that LIFO is. The other three are allowed. And that concludes our discussion of inventory.